Welcome to Real Talk, Real Estate Discussions with Andrew Kirsh. In each episode, Andrew interviews industry leaders. We'll hear their real-time opinions on today's market, their background and unique career highlights, and guidance for newcomers into the industry. You can find this show at scholarkirsh.com and on YouTube, LinkedIn, Apple Podcasts, Spotify, Google Podcasts, and more. Now here's the host of Real Talk, Andrew Kirsh.
Episode 79 and actually 80 of Real Talk. Why 2 episodes? Well, I will explain in a minute. But first, welcome to my new office at 1850 Sawtelle Avenue. An amazing office. Alana Body, my client and friend, owns this low-rise building in the middle of Japantown. I talked about it on a previous podcast. I couldn't be happier being here. It's brought new vitality and energy to our firm. We have the entire floor, about 10,000 feet. We have 4 oversized patios that every office on the window line accesses. It's a creative office feel, tech feel, concrete flooring, high ceilings, 11-foot ceilings, floor-to-ceiling windows, and a podcast studio. So you will see by upcoming podcast, episodes 79 and 80 with Matt Ferrari, the co-chief investment officer of TruAmerica. So why 2 episodes? We went an hour and 20 minutes. How could we speak for so long? Well, for about 40 minutes, 45 minutes, we talked about his career at Archstone and TruAmerica. And then the last 30 to 40 minutes, we talked about him climbing Mount Everest. And so it's not every day that you have someone on your podcast who has been to the highest peak in the world, or I should say, at least on planet Earth. An incredible story, an incredible journey that deserved its own podcast. So let's say this is part 1, which is episode 79 of my conversation with Matt Ferrari, where we focus on real estate. And then we'll get to part 2, where we talk about his climb up Mount Everest. I hope you enjoy my conversation with Matt Ferrari. Welcome to another edition of Real Talk. All right, I'm here with my good friend, Matt Ferrari. And Matt, we're making history. As you can tell, we are not in Sklar Kirsh's old offices. We are in Sklar Kirsh's new offices at 1850 Sawtelle Boulevard in a podcast studio. So welcome to my studio.
I'm honored to be the first one in the new podcast studio.
It's great. You're sitting in front of my 4 favorite people of you two. So that made it, actually, it wasn't even in my old office. It was sitting on the floor of someone else's. And now it's in the studio and hopefully the first of many podcasts in this beautiful room.
Awesome. Well, I love it. It's great to be here.
So we have a lot to talk about.
Yep.
We have some commonalities and some not so many commonalities. Commonality 1, we both play college baseball.
Yep.
Commonality 2, we're both in the real estate business.
Yep.
And where those commonalities end is you climb Mount Everest and I hike the Santa Monica Mountains. So I know
Slightly different.
Slightly different?
Yes.
I did not have to prep in a, what do you call those, like hyperbaric chambers?
That's a hypoxic tent.
Hypoxic
To create
okay.
hypoxia, which is when you have less oxygen getting into your body, so that I could pre-acclimatize at home, which allowed the expedition to be cut in half in time.
You should be able to run like a sub 2-hour marathon, I hope.
It's funny. I'm training for a half marathon right now, so I'll let you know how I do in that in October.
Wow. Okay. So let's talk first about the real estate business.
Yeah.
You're TruAmerica. Official title, I think,
Co-chief investment officer. I run our acquisitions team, as well as I also oversee our asset management team, Texas East, which is about 22,000 units, 75 properties or so.
Okay. So definitely want to get into how you're perceiving the market. But before that, let's take a step back. Where did you grow up? And let's move forward.
Yeah. So I grew up in Rochester, New York, Western New York. My voice is a little scratchy today because I was at the Buffalo Bills home opener Sunday night.
An epic opening game.
Unbelievable comeback, less than a 1% chance of winning. And look, when you have number 17 on your team, anything can happen. So grew up in Western New York, went to college in upstate New York, Saratoga Springs, New York. The Skidmore College Thoroughbreds, played Division III baseball there. which I think is the purest form of college athletics. No scholarships, for the love of the game. So played 4 years of college baseball. That's really what drove me to go there.
Or you could have been a shitty ball player like me who played Division I and didn't get a scholarship. It was a recruited walk.
So still love of the game, right? Okay. So played ball there for 4 years. We weren't very good our first 3, but our last year we went to the NCAA tournament, and I ended up missing my college graduation because we were still playing that deep into the season. I think we were like 18 teams left out of 350 teams. After college, I actually moved back to Rochester, New York, bought a 3-unit triplex because I had a mentor at Skidmore, Dean File, who I was paired with her through the business department, and they paired me up with a business person in this community. She ended up being my mentor for 3 years, and she had a small real estate business in Saratoga, which made me very interested in real estate. But I actually moved back to Rochester, bought that triplex because I wanted to get into real estate. But actually, my brother had started a website where we sold supplements on the internet called quick2you.com. And so I teamed up with him, really grew that business for many, many years. This was in the days where Google sent us Christmas presents because we were such a big customer.
Wow.
You didn't have to spend that much money to be a big customer.
Wait, so what year are we talking about?
So we're talking 2005, 6, 7.
I feel like Google was a multi-billion-dollar company.
They were big, but they were nowhere near what they are today.
Okay.
And most people at the time didn't even know how Google made money.
Right.
It's all through AdWords. So we knew how to use AdWords, and then my brother was a computer programmer, could create the whole back end to our websites. And then I was kind of the business guy that kind of did a lot of the business strategy, and we ended up having our own products made, and just sold hundreds and hundreds of different products all over the internet. Create a couple of different websites.
He sounds much smarter than you.
Significantly smarter. And so I was doing that, living in Rochester, wanted to always get into real estate, bought the triplex, started my MBA part-time at the University of Rochester Simon School of Business, just because I didn't know where this business would go, and really liked that setting in business school quite a bit, and did not want to be in Rochester for the rest of my career.
Why not?
It's a great place to grow up. The winters are brutal, but coming out of Skidmore, most people from Boston or New York. Most people went to Boston, New York, or DC after college, and I was kind of in this small city, and so I thought I want to go to business school full time and kind of get into real estate. So I applied to business school all over the country. Ended up getting into Georgetown. Had a good friend from Skidmore, my buddy Russell Dye, who's a lender at Walker & Dunlop, who was having a good time there. I went to visit, stayed with him, and I thought this would be a great place to spend 2 years. So ended up coming to an arrangement with my brother so I could kind of sort of step away, and went to Georgetown for business school from 08 to 10 with a goal of pursuing real estate.
Yeah, and what was the first job after business school?
Well, so interestingly enough, 2 weeks into business school, Lehman goes bankrupt.
Yeah. I remember those days.
Yeah. So, and really, like, I'd heard of Lehman Brothers, but I didn't really know investment banking and finance and all that stuff. So I was like, they're talking about leverage buyouts and all these things my first couple of weeks. And the interesting part is my first job after business school was actually working for Archstone, which was Lehman's biggest asset. But by the time I graduated, Lehman's now bankrupt.
When you say it was Lehman's biggest asset, where their equity position in Archstone.
Yeah. So what happened was there's no like jobs. Like I didn't even do an internship in real estate in 09. I actually studied abroad at Oxford through a program Georgetown had, because I never got to study abroad during undergrad because I was playing college baseball and never wanted to miss the fall or spring season.
Same.
So I ended up doing the summer abroad program, get out in 2010. Really, there weren't a lot of real estate jobs. And one of my friends from a different MBA program sends me this job posting for a company called Archstone. And they had apartment buildings all over DC, very sexy mid-rise, high-rise properties. I actually bought most of them from Charles E. Smith. And it was a rotational program where you would move every 6 months and rotate around the country, including 1 6-month rotation at their corporate headquarters in Denver. And so back to your question, in October of 2007, Lehman and Tishman Speyer took Archstone private. So Archstone was a publicly traded REIT. They were the first REIT to really do the pure gateway strategy. So Scott Sellers, our CEO, sold a lot of assets in the Southwest and the Southeast and started buying in the coastal gateway markets and built up a very urban gateway city portfolio. And so Lehman takes them private, and not even a year later, they now go bankrupt and were their biggest asset. I, of course, didn't join until 2010. During that time, right when I joined, Lehman, BofA and Barclays had provided a lot of debt for the take private. So they did a debt for equity swap, where now Lehman owns about 47% of the company when I shortly after I joined. BofA and Barclays own the other half.
So was it, I mean, I was actually doing a lot of work for Lehman post bankruptcy, part of the cleanup crew representing Lehman in the sale of everything from, I don't know, large assets to raw land in the Inland Empire.
Yeah.
So was it part of disposition city where you're just selling everything, or were you able to, I don't know, get new equity, buy? What was your role?
Yeah. So what I did what I ended up doing at Archstone, interestingly, so previously, and then I'll get to exactly what happened there, because I was involved in it as like a little gopher in the room with all these very senior people and law firms and investment bankers. So they had this rotational program where historically you would rotate in development and acquisitions and corporate finance, what we'll call typical post MBA functions. But Archstone didn't need to hire people to kind of do acquisitions or development because they'd laid a whole bunch of people off. So they could just rehire those people. So they said, how can we use this rotational program we've had for decades to infuse talent into the company? So it's going to be a focus in operations. So basically property management. They liked my operating background pre-business school, which was running my own business. So I spent my first 3 months in Northern Virginia working at a 912 unit high rise called Archstone Crystal City. Today it's across the street directly from Amazon HQ2. And I worked every on-site job. So I worked the front desk on Fridays. I leased apartments. I was an assistant manager. I remember my first assistant manager kind of sit in conversation for renewals. A resident crumpled up the renewal and threw it in the actual assistant manager's face and walked out. And he looked at me and goes, well, that's not how they usually go.
And probably not what you studied at Georgetown.
Exactly. But it was a great way to learn the foundation of apartments, like just being in the trenches. I was a service tech for a few weeks. I'm not handy. The service tech sort of just joked with me and kind of, would have me cut some pipes that were, who knows what was coming out of them.
This wasn't in the job description.
No, but it was a great way to learn the nuts and bolts of business. And Archstone was the very best operating platform out there. They invented online lease. They invented revenue management with LRO. So they were at the forefront of best-in-class operations. Well, then I moved to Denver to do my headquarters kind of rotation, and Archstone had just created a procurement group. And so I actually did a national RFP for elevator maintenance and pest control for 3 months. So learned all about bed bugs and the best treatments and elevator maintenance. And then the executive team came to me and said, there was a gentleman who was kind of running the day-to-day of, we'll call asset management of Archstone from Lehman. He was kind of the liaison between Archstone executive team and the company and BofA, Barclays, and Lehman. And that summer of 2011, I'm living in Denver. They decide they're either going to sell the company or file the S11 to go public. Mm-hmm. And so I was kind of like his analyst. And so we get in the room one day and it's, BofA's bankers, Barclays bankers, and then Lehman's bankers, all their law firms, and then the executive team, and then like me sitting in this room. And we start like going line by line, the draft, that's 11. At the same time, there's also bankers working on just a sale. So every time the investment bankers would go to my boss, web neighbor from Lehman with a bunch of questions, it's no different than when you're just buying an apartment building. There's this data room being loaded. I would be a gopher saying, I'm doing a special project for web and I need an answer to this question. I'd go to this department or that department. And I would then like help them compile the war room. And so we're doing this dual track in the summer of 11. That summer, Sam Zell with EQR decides to try to buy 25% of the company. That's the same summer the S&P downgrades the US debt. Capital markets going to tailspin. My sense was from just talking was that BofA and Barclays just wanted this off their balance sheet. We're coming on the GFC. they don't want a huge apartment company on their books. Lehman really believed in the executive team. Remember, they were the ones that took the company private and felt like there was much more value to unlock for now their estate by hanging on. So Lehman goes to bankruptcy court, gets $6 billion from the judge to match Sam Zell's offer. Sam Zell then had the right to buy the next 25%, because remember, Lehman owns half, BofA and Barclays on the other half. So now they've sold down half their position, the banks. Sam tries to buy the next 25%. Lehman gets money, matches that offer. Lehman now owns 100% of the company. And kind of my project ends. Sam Zell gets $150 million breakup fee for just making some offers, right? I moved to New York City to now get back into my operations program at the end of 2011. I get assigned to managing a 192-unit high-rise on Montague Street in Brooklyn Heights. I do that for a couple of weeks. At the time, my boss in New York was Linda Early. She runs Brookfield's management company. She was my VP. I always joke to this day. She told me, I'm very concerned about you coming to manage this property. And I remember thinking, in 6 months, I'm supposed to be a regional manager, and you're worried about me running a 192-unit high rise. She's actually one of our partners today at TruAmerica, so we get to joke about this a little bit. 2 months in, she sits me down and says, Matt, I'd like to move you to a different property in Midtown Manhattan, 550-unit high rise. I was actually living in it. So I was thinking, well, you just told me 2 months ago you're worried about me running a 192-unit high rise. Now you want me to run a 550-unit high rise. I managed that huge property, 25 union staff, big office, do that, did a very good job with that. And now it's time for me to become a regional manager. I become what they call an operations manager. I get assigned a portfolio of assets across New York, staying in New York, working for Linda. And I'm on this called fast track operations program within a company that I absolutely fell in love with, drank the Kool-Aid and rotated all over the company, knew a lot of the leadership, and just really believed, everything about Archstone. A few months later, Scott Sellers gets on a call, and we were all thinking, we're going to go public. And again, I'd been very close to it the previous year, and I knew how Lehman felt about us. So I'm thinking, this is the announcement that we're going public. Well, it turns out Scott says we're being sold to a joint venture of Avalon Bay and Equity Residential. So 9 months earlier, they had done the equivalent.
So Sam Zell finally got his company.
Yes. So we come full circle. My first week at business school, Lehman goes under. I take a job with Lehman's biggest asset, and now a couple years later, I'm going to lose my job because Lehman has now sold us. I was devastated. I loved Archstone so much. It was the best thing that happened to me ever, that could have happened to me in my career.
And so you didn't stay on after Avalon and Equity?
So what happened was Avalon and EQR do a fantasy, kind of equivalent of fantasy football draft. EQR is buying 60% of the properties. Avalon's buying 40%. They pick the properties. If you worked at a property, you went with whoever bought your property.
Understood.
Now you have all these corporate employees. Well, Avalon and EQR also both have great operating platforms. So they don't need most of the corporate people.
Yeah.
But what they do need is operations corporate people, regional managers. I'm a regional manager. And so what they came to an agreement that they couldn't bid you up. If they both wanted you, your pay had to stay the same. And then you interviewed with both. They would make you an offer. You knew what your pay would be, and then you picked. And so what we'll call the round one offers.
This is the Jamar Chase, Josh Allen going into the first round. Of the,
exactly. So now I interview with both.
I put Josh Allen.
Yes, the best player in the NFL, maybe ever.
Don't you have to win a Super Bowl in order to be the best player?
Baby steps,
Okay.
Andrew. One thing at a time. All right. Let's see how the season goes. He's young. Just needs to stay healthy. So I interview with both. And because Avalon was only buying 40% of the company, they didn't need as many regional managers. But many of their VPs took a liking to me, and they said, look, we love your background. It's very interesting. Why don't you move to Arlington, Virginia, and be like a super GM, and we'll assign you 3 properties, but you're going to have to go back on site. EQR said, you could be a regional manager in Boston, New York, or DC. We don't really care. We just want to get you on board. Well, I take a long time to I get 3 days to decide. I go to the very end. I'm actually touring our CEO at the time, Tim Nahn of Avalon Bay, and Matt Berenbaum through our New York portfolio. Linda was going to Avalon. Her boss, Matt Smith, who now runs asset management and property management for Starwood. He's also going to Avalon. I wanted to go to Avalon, but it was a job that it was a lower job, even though I was being paid the same. So along the way, I had a 30-minute meeting on my interview day with Avalon with their head of acquisitions, Pat Nidek. And he must have taken a liking to me. So I'm about to make my decision and call EQR. I'm taking the job with them. And I get a call from Avalon Bay saying something's changed. We told EQR you need one more day to think about things. Would you consider a job on our investments team? And I'm like, absolutely, because like that's what you go to business school for, to do acquisitions, dispositions.
Not to plunge toilets.
Exactly. So I was supposed to go to Denver to go skiing. I changed my flight. I take the train down. I spend the day with Pat. I meet some other folks. And it's 4:00. I've got a flight at 6 to fly to Denver to go skiing. And it says, okay, you have your offer with EQR. You have an offer to via GM here. You know what your pay is going to be. I don't even have an offer letter for you, but I can make an offer to you to be a investments manager on my team doing acquisition dispositions. What you decide impacts the next round of offers for Archstone people. So I can give you 15 minutes to think about it. I'm going to leave this room. We're in a conference room, like this, not a podcast room, but a conference room.
No fancy microphones.
Exactly. And it says, I'll be back in 15 minutes. You can tell me your decision.
Do you get to phone a friend?
I said, I don't even need 15 minutes. I'm taking the job on your team. And he stands up. He said, I don't hire people who just shakes my hand. And that's how I pivoted from property operations to doing transactions and deals.
Wow.
Like Pat saw something in me. And then he not only saw something in me, but I didn't have the whole analyst upbringing like you would typically have. I didn't have I wasn't great with Excel.
I was going to say, it's funny that you say you're not great with Excel, because it used to be one of my early podcast questions.
Yeah.
How good are you at Excel? And a lot of people say, I don't even use it.
Yeah.
Now we are 20 minutes in.
Yeah.
So we haven't even gotten to TruAmerica.
I know. So we'll get there.
Okay.
So
by the way, you are the first person I think that I have spoken to who has had this type of just like training from an operational perspective. I feel like most of my clients have the training from the investment side, not from the operations side. And so you have a totally different perspective on what it takes to own and operate
100%
real estate.
And so now I'm working for Pat. He takes me under his wings, an unbelievable mentor. Really taught me how to, negotiating contracts and dealing with your buyers, retrading, underwriting, best in class platform. I'm there for 3.5 years. I love working there. Great relationship with him, no intention of leaving. And I get a call one day. I was at a Nationals game at a Georgetown real estate networking event. I get a call from Greg Campbell. He's the head of acquisitions at TruAmerica. I remember seeing them in the news buying deals out west. Greg actually worked at Archstone. I didn't know him, but I was able to kind of vet him a little bit. I didn't know who Bob Hart was, but I called. So when I was in the Archstone program, I had a peer on the West Coast, buddy Ben Mayberry at Abacus. So I called him up. I said, what do you know about Bob Hart? All my Archstone colleagues are like, loves to do deals, great place to work. If you work for Bob, if you are a young acquisition person that wants to transact. And so they were looking to expand to the East Coast. At the time in 2016, we were a West Coast only firm. Yep. So I interview with them. They want to build an office around someone as a director of acquisitions. I do my vetting, come out to LA, cut the deal with Bob and Greg. And I end up telling Pat I'm leaving. It was a very difficult decision. And I basically in the DC Metro finding office space, hiring grad school interns, my first grad school intern, Greg Zartarian, and just building out an office, putting a business plan together. Hey, where should we buy? Do a bunch of research. We had bought a couple portfolios in Maryland that Greg had gotten going. I suggested we should start out in Florida, picked off a few deals there. About a year in, Bob comes to me. We were trying to get asset management operations right on the East Coast, but from LA. So he comes in and said, Matt, you have an operating background. Would you be interested in running East Coast asset management as well as acquisitions? So of course you're going to say yes. So I start building out, kind of rebuilding our asset management team, working with our head of construction on that. And we just start buying up and down the East Coast. I've actually expanded the Texas market, built an office there, actually hired a former Archstone colleague who was in the same program as me a couple years before me, Emmanuel Meta, to build out that office, and became a fully national firm.
Very quickly.
Yeah.
I mean, I remember meeting Bob Hart with Noah Hockman at an IMN conference in Laguna. I'm going to say in 2013-ish.
Yeah, he started platform in 13.
Yep.
I joined in 16. Like 2020, we were fully national, kind of covering the whole country.
And today, what is it, 18 billion?
Yeah,
or so?
16
billion.
Fluctuates over 16, 17 billion. We own over 40,000 units, third-party asset managed, another 20, so north of 60,000 units. Have our joint venture business, have our fund management business, have separate accounts. I mean, it's a full national business, and it's just been unbelievable. I had my 9-year anniversary, I think, 2 weeks ago.
Happy anniversary.
Yeah.
So what is it like from working at a company that's totally established, has its rules and procedures in place versus you're running the East Coast of, I don't want to say a startup, it had been around for a couple of years, but not a company of like Archstone's legacy. You were basically creating your own business and hiring people and responsible for that, in addition to being a real estate investor.
Yeah.
You had a lot of things on your plate. So talk about the differences in that role.
I mean, I think you hit the nail on the head. Like Avalon Bay, this REIT that's massive, been around for forever, has it really figured out. Same with Archstone. And then TruAmerica is a few-year-old company, extremely entrepreneurial. Bob's background, Bob's driven me by the duplex, his first real estate he ever bought in Venice, right? Like, so I think it was an environment. I think that's what attracted me to Bob, was he is super entrepreneurial. There was what we'll call an established business, but very moldable. And then I think Bob's management style and the way I work, where he really values is people coming in and taking charge of whatever they're assigned to. So I think it was a great kind of marriage, because I could take best in class processes from these fantastic companies like Avalon and Archstone, apply them to TruAmerica, but still not over process things or make it too bureaucratic, so we could still stay very flat and entrepreneurial. And it was an environment I just really thrived in, which made it just very exciting to be there.
So how was it in winning deals? So TruAmerica was not a household name on the East Coast. Bob Hart came from Kennedy Wilson, more of a West Coast company. So you're establishing broker relationships in Mid-Atlantic and in the Southeast, and you say, okay, TruAmerica. Did it resonate? Did you have to overspend? How were you able to get those first few deals?
No, so I think in the beginning, look, if you went to CBRE or JLL or all the big brokerage shops, a broker in the East Coast markets could call a broker on the West Coast market and kind of learn about us. But I can remember going up to brokers. I always tell the story, the first deals that I bought were in Orlando, from Sheldon Grenade and Luke Wickham. They were at CB at the time. They were with IPA today. And I just remember going up to Shelton at MHC and being like, I'm Matt Ferrari with TruAmerica, and I want to buy deals in Orlando. And of course, they probably get that all the time. And they're like, sure. And sure enough, I think I've done 15 transactions with them since. So it's like we actually made it happen. But no, we had to PR our name. We made sure everyone knew when we were buying in a market. We had to be out in front of people. I think very different than who we are today, where everyone just knows of TruAmerica.
Aggressive with deposits.
For sure. Sometimes non-refundable money, a PSA signing. I can remember the first deal we bought in Tampa, a broker showed it to us off market. And I was like, well, how did you know to call me? He's like, well, I saw on the press that you were buying deals in Orlando. That was the first deal we ended up buying in Tampa. So just always on the road. Bob has a saying. I remember I found our office in Arlington, Virginia. We built it out. I sent him a video and he said, Matt, office looks great. Now don't spend too much time there. Nothing good gets done in the office. So just on the road all the time, in front of people, whether it's a conference, meeting with brokers, meeting with sellers. We call it TruAmerica triangulation, trying to figure out what angle we can have to win a deal, whether it's through a broker, through a seller, whatever relationship it can be. And I can remember I was bidding on a deal in Orlando early on. And Bob was like, well, what's your angle? Like, it was just a market. It was, what's your angle? Like, you gotta have more than just bidding on it with the broker. And so I think that just that entrepreneurial component to us enable us to kind of build out our brand and name, and even attracting talent to the platform. And most people on the East Coast didn't know us. We're hiring people out of business school. They want to go work at, big private equity shops and whatnot. They hadn't heard TruAmerica. Today, I get people all the time are like,
national name.
Exactly. We want to work for you. This is the company I'm targeting. But back then, we had to be scrappy. And I think
no different than Sklar Kirsh.
well, exactly, right. And well, here we both are. So I think just the scrappiness, like we say at TruAmerica, look, we're Main Street people. We are roll up your sleeves, operators, get in the weeds to win a deal, to operate a deal, to construction management a deal. That's the way, that's who we are. That's our DNA. And it's for some, it's not for everyone, but that's kind of how we roll. And I think that is just stems from Bob and the way he runs things.
So let's fast forward to 2025 to today. Otherwise, we're going to have a Joe Rogan 3-hour podcast.
1.5 times speed.
There you go. I love you here. We can go all day, but I know we have a lunch with my partner, Katie, as well. So talk about the market today, where you guys are positioning yourself. Obviously, in the last 6 to 9 months, we have seen a significant uptick in transactional volume.
Sure.
What's your perspective on today's market?
So I think transaction volume is picking up. If you still look at it compared to the last 10 years, it's pretty low. I think what has happened over the last, call it 24 months, is that the spread between buyers and sellers continues to narrow. It's narrowed the most on the newest vintage product, and it's, I think, the widest still on, we'll call 80s or older product.
Sure.
And so, but I think that's going to naturally kind of catch up. Then we've been in a higher rate environment, and in much of the country, mostly the Sun Belt, you've had negative new lease trade out, maybe positive renewal. So net, you're a little negative, a little flat, or a little positive. So if you've got rents going flat or down, you need a higher cap rate to buy. And then what type of growth are you underwriting? And then you have higher interest rates. So I think all that got very painful, call it back half of 22 through 2023, which was really tough. And then I think now the worst is definitely behind us, both operating fundamentals and capital markets. Equity's more interested, debt's coming down a little bit, we're closer to rent growth. So I think all those coming together should cause a steady increase in transaction volume. And I think what's really happened is most groups just think there's going to be better days ahead when it comes to sell, which is making it hard to buy. If you look at the GFC, there was no one wanted to buy, but people would have sold. Today, or what we'll call the slowdown in transaction volume we've seen in the last few years, there's been plenty of willing buyers. There just hasn't really been willing sellers. So there's the occasional forced seller. Then look, we've sold some deals where it's like, look, we bought them 7, 8, 9 years ago really well, 5 years ago. We think it's going to get better, but like we're happy to take a profit. So we've had occasional disposition of that, but that's just not enough transactions to kind of speed up the market. And then I think what also happened is go back to 21 and 22, values were going up so fast that if we were underwriting a 5-year hold, you could sell that in 18, 24 months. So we kind of pulled together a whole bunch of profitable sales. Now the deals I bought in 21 and 22 was at more peak pricing. You're just going to have to hold those longer. It doesn't mean if you capitalize them the right way with the right debt, it just means it take longer to get to the profit and goals you're looking for, maybe returns. And so I think that's what's called this transaction market to sort of stall, but it's picked up because the things I just described are improving on all fronts.
Well, how are your legacy assets of those 21 and 22 acquisitions? Obviously, a lot of my clients who did buy in that time period with floating rate debt, they are having a tough time right now.
Yeah. So I think a couple things we did that was maybe different than others was we had historically been a floating rate buyer. We were doing a lot of agency of floating rate debt. At the end of 20, rate caps were incredibly cheap.
Mm-hmm.
And so we ended up buying 3-year rate caps at strikes of sub 100. So those agency deals, the first year was a throwaway, rates stayed low, but the next 2 years we were super in the money on those caps. So that allowed us to, I think, create a lot more cash flow than most people have floated. And then what we saw in the middle of 2021, we pivoted from floating rate debt to fixed rate debt. But even the debt we did in the beginning of 21, we again bought 3-year rate caps in them that were sub 200 strikes. I think in our first fund, we maybe paid $500,000 for those rate caps, and a year and a half later, they were $30 million. Then when Jay Powell in the summer of 21 said inflation was transitory, but rents were going up double digits across the country, and the way CPI is calculated, shelter lags by a year, we thought, how could that be transitory? So we pivoted more fixed rate debt or swapped bank debt, in the back half of 21 through 2022. A lot of call it 5-year fixed rate debt in the mid threes. And so I think the key is how you capitalize the deal on the debt and equity side can allow you to ride out tough times in real estate. And so I think if you did a lot of high leverage floating rate debt with short-term rate caps, you're in a lot of trouble. We pivoted more fixed rate debt, which was not what we had historically done. We've been doing mostly that since. So I think we were able to kind of figure that out. I think maybe where I was maybe a little wrong was I thought, maybe SOFR goes into the mid threes, not the mid fives. Maybe this is a 3-year blip, not what's going to be a higher elevated interest rate environment. So I think we diagnosed it properly, adjusted our strategy properly. In hindsight, instead of doing 3-year swaps, I wish I had done 5-year swaps. But I think that's allowed us to be on offense at a time where many are still on defense.
Mm-hmm. Now, in terms of the types of deals that are interesting to you, you got the newish construction, we'll call it post 2000 build, but so many institutions are chasing those types of deals. Returns aren't that great. And then there's the 80s product where there's not a lot of capital, but the returns are juicier. What is TruAmerica doing?
So part of it depends on the capital we're deploying, because we have our workforce housing fund, which is, we'll call B- to B+ apartments in the East and West Coast. And we have our JV accounts, and we have some separate accounts that are focused on core plus. I think at the end of the day, when you're buying today, it's the most exciting time to be an apartment investor. If you look at what happened before COVID, everyone made money. It didn't really matter if you were a good or bad operator. Rent growth was better than people thought. Cap rates came down. Debt was cheap. Today, there's a variety of mismanagement across assets. Some are, some aren't. So you have to pick through a lot of different assets. Some submarkets will grow better than others. Some markets will grow better than others. Some need too much capital, CapEx. Some need just a medium amount. So I don't think, to me, it's as much about what vintage will I buy. I think it's very asset specific and geography specific. And that's what real estate should be. And so I think the best operators are going to be able to kind of figure out which deals they can add value to construction wise, technology wise, implementing institutional property and asset management. And then can you just get a good buy? Which deals is the seller saying, I'm only selling at this number, wanting to sell versus needing to sell? So I think there's some great new vintage assets. I think there's some great older assets. And if you look at what we bought over the last 12 to 18 months, it ranges from 80s to 7-year-old product. And I think it really comes down to underwriting that specific asset. And then can you put your money where your mouth is when it comes to operating it? Can you truly control the controllable expenses? Can you control your non-controllable expenses? We've had insurance spikes. How are you managing that process? Some groups just have their MIP that continues to go up. Others are more creative. Are you appealing your taxes? How are you handling utilities? I think, there's so many ways an operator can add or destroy value. And I think it's buying from the ones who've kind of destroyed it and mismanaged the deal, or buying in a market with really good tailwinds, or just buying a deal at a good price. It's not one vintage or, I think you have to really look at the specific asset. And this is when investors are going to differentiate themselves from each other. And that's exciting.
Now, there's really no secret sauce in real estate. It's not like a tech company that has, IP that's proprietary.
Sure.
So to the extent you even want to talk about it, and if you don't, that's fine too. Where are you finding those advantages in terms of cost savings? Is it the scale that you guys have? Is it certain technologies that you've met certain vendors, but those vendors are available to your competitors? So what is it where you could drive your operating costs down?
I think step one, you just have to be willing to dedicate a team to think about it. And look, a lot of people just bought a property and it went up 25% in value in a year, and then they sold it, and they never really had to think about how are they operating. or how are they staffing their properties? I think there's so many different ways to operate an apartment. Like, do you self-manage? Do you use third-party management? There's pros and cons of that. Do you do your own construction management? Do you rely on a management company? What technology are you using? How are you procuring insurance? How are you handling taxes? How are you figuring out controllable? Are you doing some ancillary other income? I think there's a lot of things operationally that it's an operational intensive asset class that can impact the outcome of the deal. Look, at the end of the day, multifamily will do well or it won't. I think it's poised to do very well over the next several years. And I think your goal as an operator is to kind of outperform your peer set. So look, if multifamily averages a 15% IRR on the acquisition side for the next 5 years, like if you're a good operator, you should be able to be a few hundred basis points above that. And if you're mediocre, you might do a few hundred basis points worse. And of course, also market and sub-market selection.
I was just going to talk about
combining all of those things, I think determines, do you outperform or underperform, right? But I think from the operational perspective, like you just have to have a commitment to being focused on it. And I think my operational background, having lived it before I ever did transactions, my expectation for the investments team at TruAmerica is you are underwriting like an operator. You're not underwriting what I call abracadabra acquisitions.
Isn't that a Lady Gaga song?
I don't know. Is it?
I think I look. I'm a 10-year-old girl,
Yeah.
so that's what's on.
There's acquisition people. I think like, oh, we'll just be able to do this, this, and this, and abracadabra will just happen. Well, like I lived it. I know what it's like to implement some of these ideas and what's realistic and not, and what's realistic underwriting. And so I think it's got to start with the people who are buying the assets to even look at what's realistic and not just try to make the deal work for the sake of it. Look, if cap rates go down 50 basis points, people get bailed out. Great. But I prefer to have really good process, and then the results will be what they are versus getting lucky for good results.
Last question on real estate before we go into your little hobby.
Okay.
Has your not perception, but has TruAmerica's thought process with respect to markets changed in the last 12 to 24 months?
Of course.
And so
they're always evolving.
They're
always evolving. Look, I think if you find a great opportunity, you prefer that great opportunity to be in a market or a sub-market with projected tailwinds, which means projected better rent growth because of demand, supply, whatever, than headwinds. But if it's priced properly and you think you can add a bunch of value, it could be in a market with some short-term or medium headwinds. And then there's also the regulatory side of things. And that's very hard to underwrite.
Well, like the state that we're sitting in today.
For sure.
You guys do very little in California right now.
I don't think Bob would want you to say that. We've bought some big portfolios here.
Oh, well, actually, we did close your affordable.
Exactly. So we have that, and we bought a very large portfolio in San Diego. I think we are selective about everywhere we buy, and we've taken all these things into account. And markets evolve from year to year for a variety of reasons. This market might be poised to do really well for the next couple of years, and then that market might not be as interesting. The Sun Belt was where everyone wanted to be. Now there's a lot of supply. Rent growth's been tough, and there's other markets like we're in Columbus, Ohio. Best lease trade out within my we'll call Texas East portfolio that I oversee. Suburban Boston has done very well. Suburban Seattle has some signs of life. Mm-hmm. Certain Sun Belt markets are going to grow sooner than others. Right. And so you always have to be re-underwriting which markets have what, pros and cons. But then you also have to be looking at the asset specifically that you're buying. And it's that collective combination that determines if it's a good asset to make the buy on. And then, you got to put your money where your mouth is. You got to go. The hard work starts at the closing. Now you got to implement the business plan, and you got to do it for a long time. And you got to be in love with the operating process day in, day out. And that's what we stress to our asset management. You have to love the process. It's kind of the same process week in, week out, following up on the same things.
Now you sound like Scotty Scheffler. Love the process.
But you have to.
You've been listening to Real Talk, Real Estate Discussions with Andrew Kirsh. You can catch prior episodes at scholarkirsh.com and on YouTube, LinkedIn, Apple Podcasts, Spotify, Google Podcasts, and more. Thank you for your positive reviews, comments, and for sharing the show with others.